Imagine you have just spent a grueling month at work, slaving away for every cent, only to find that when your paycheck finally hits, over $500 has simply vanished into thin air. This is not a glitch. It is the invisible reality of the financial system you live in. Your money is trapped by three invisible forces, and if you do not understand how they work in the next 10 minutes, you will continue to work for them for the rest of your life. Picture this. You are expecting $2,000, but your bank account only shows $1,456. You see deductions for federal tax, state tax, Social Security, and Medicare. This is the modern ritual of giving away a chunk of your life to forces you cannot see, and most people just accept it as the cost of civilization. But what if I told you that you are not just losing money, you are losing your time, which is the only asset you can never get back? If you feel like the rules of the game are rigged against you, you are absolutely right. But today, I am going to show you how to hack this system and turn these shadowy algorithms into your best unpaid employees. The truth is that money itself is not even real in the way we traditionally think it is. It is a social construct built on a shared belief and trust. The only reason a $100 bill can buy you a high-end dinner and a random stick from the woods cannot is simply because we, as a society, have agreed that the paper has value. Once you realize that money is just a tool to organize human effort, you can stop being a victim of the system and start becoming the one who sets the rules. You might feel nervous right now. You might see terms like index funds, capital gains, or fractional reserve banking and feel a sense of dread. That nervousness is actually wisdom. It is like the first time you get behind the wheel of a car. You are anxious because you have never driven before, but once you learn the rules of the road, you develop a level of competency and comfort. I have studied the systems used by those who survived the Black Monday crash of '87, the dot-com bubble, and the Great Recession of 2008, and today I am going to share that logic with you. Let's start with the first invisible force, which is taxes. Taxes are the price we pay for roads, schools, and making sure the taco truck down the street isn't a health hazard. You pay income tax on what you earn, sales tax on what you spend, and then there is the hidden one, capital gains tax. This hits the money your investments made while you were asleep. Then you have Social Security and Medicare, which are essentially the government forcing you to save for a future they promise to manage for you. Taxes are a slow drain, and while countries with higher taxes often have a higher quality of life, you need to know how to protect your portion. The second force is the banking system. Most people imagine a bank as a giant safeguarded by a dragon. In reality, the bank is just a middleman or a matchmaker. When you walk into a bank and deposit $1,000, they do not keep it in a vault. Through a system called fractional reserve banking, they keep a tiny fraction and lend the rest out to someone else who wants to buy a jet ski or a house. They are using your money to make their profit. They charge the borrower a high interest rate and give you a tiny, insulting fraction of a percent for the privilege of holding your cash. You are the supply of money, and the bank is just the broker taking a massive cut. While the bank is playing matchmaker, the third invisible force is acting like a slow-burning fire under your savings, and that is inflation. Inflation is what happens when money slowly gets less valuable over time. It is why a bag of chips looks half empty and costs 30% more than it did last year. Your $5 bill still technically says $5, but it buys fewer instant noodles and less gas than it used to. If you just leave your savings sitting in a standard bank account, you are essentially watching your purchasing power quietly vanish while the bank uses your money to get rich. It is a self-fulfilling economic prophecy, where expectations of rising prices drive them even higher. But there is a way to fight back, and it is what we call the silent engine of wealth, interest. When you borrow money, interest is the rent you pay to use someone else's cash. But when you invest, interest becomes your reward for being patient. Simple interest is just a flat fee But compound interest is a total cheat code for reality. It means every dollar you save has clones, and those clones also start earning rent for you. $100 becomes $200, then $400, until one day you wake up and you are old, rich, and perhaps a little bit smug about it. This is how ordinary people with modest paychecks retire with 7 figures. They didn't beat the system, they used the system's own engine against it. To understand how to put this to work, you need to understand what a stock really is. Imagine a woman named Sarah who wants to start a pizza restaurant. She needs $100,000, but only has $50,000. Instead of going to a bank, she finds investors. She divides the ownership of her pizzeria into small pieces called shares. When you buy a share, you become a part owner of that business. If Sarah's pizzeria prospers and opens 3 more branches, the value of your tiny slice of the pie increases. If the restaurant succeeds, you might even get a dividend, which is a direct share of the profits sent straight to your pocket as a thank you for being a shareholder. However, trying to pick the one winning pizza shop out of 10,000 is incredibly difficult and risky. This is why most successful long-term investors prefer something called an index fund. Think of it like a music chart. You know how the top 40 charts work. The songs that people download and stream the most rise to the top, and the songs that lose popularity fall off the chart. An index fund like the S&P 500 is exactly the same, but with companies. It is a list of the 500 largest companies in the United States, including giants like Amazon, Google, and Apple. By investing in an index fund, you aren't betting on one song. You are betting on the entire music industry. If one company fails, it simply drops out of the chart and is replaced by a new rising star. Your money stays protected because it is spread across all of them. The most powerful way to build wealth is to automate this process, so you do not even have to think about it. You could invest $5 a day, which is roughly the price of a coffee at Starbucks, and over several decades, that small consistent action can grow into a portfolio worth over $1 million. When you set up your investment account, you should look for the word accumulation, because that means your dividends are automatically reinvested to buy more shares, which lets your money grow even faster. This is how you train your hours to work for you instead of you working for your hours. Before you jump in, you must ensure you have a foundation of safety. You need a fully funded emergency fund that covers 3 to 5 months of your living expenses. This is your insurance against life. It means that if you lose your job or your car breaks down, you never have to sell your investments during a market downturn just to pay your bills. You should also look for tax-advantaged accounts like a Roth IRA or an ISA, depending on where you live. These allow you to grow your wealth without the government taking a massive cut of your profits when you are finally ready to enjoy them. You also need to understand your credit score, which is a shadowy algorithm that decides whether you get a house or a soul-crushing 27% interest rate on a loan. This number isn't about how much money you have in the bank. It is about trust. Lenders want to know that if they give you money, you will actually pay them back. It tracks your payment history, how much of your limit you use, and how long you have had your accounts. Your credit score is like a pet. If you ignore it, it poops all over your life. But if you take care of it, it will eventually help you buy a home. The hardest part of this entire journey is not the math or the terminology. It is the psychology. When you see the market crashing and your account turns red, your friends and the news will panic. They will tell you to sell everything and hide your money in a mattress. They did this in 1987, in 2000, and in 2008. But history shows that the market has always recovered and reached new records. If you had invested just $250 a month starting in 1985, you would have over $1.8 million today, despite all those global crises. The real danger is not the market going down for a few months. The real danger is never starting at all and watching inflation quietly steal your future while you sit on the sidelines. Time is the most valuable asset in the world, and unlike money, No one gets an unlimited supply. Most people trade their time directly for money, 1 hour for one paycheck. But the top earners have figured out how to use leverage and how to train their money to work while they sleep. Wealth isn't built in days, it is built in decades. Money that sits quietly in a well-diversified investment doesn't just grow, it multiplies. It starts slowly, almost invisibly, then it moves faster and faster until it becomes an unstoppable force. You are trading your money today for more time and more freedom tomorrow. Every dollar you invest is a seed for a tree that will eventually provide shade for you and your family. Do not wait for the perfect moment or for the right market conditions. The best time to start was 10 years ago, and the second best time is right now. Stop working for the invisible forces and start making them work for you. Become the king of your own financial category. If you enjoyed this video, like and subscribe to learn more about how money really works.